Hello everyone, welcome back to my channel. So this video marks the end of the week number 65 and this road to 100k realized return challenge. And this week has been a quite volatile week. Most of the developments that made the markets move this week were about the company earnings. There were a lot of earnings this week to account for, and especially probably the two highest profile earnings were Tesla and Netflix, both of which did not beat. They came short the earnings estimations by analysts, and that brought in or caused some additional volatility in the markets. However, so far, and on an aggregate level, most of the companies have been earning revenues and earnings estimates, which is a good thing. But still, yeah, this is something to be on with a watchful eye, because these companies which have been driving and powering forward the market, the so-called Magnificent Seven. So far, these two have failed analysts' expectations and earnings expectations. So this is something that we need to see if it continues, especially next week when we have more of the Magnificent Seven companies announcing their earnings. Among them, Microsoft, Apple, Amazon, and Meta as well. And so, as you can see here, this is the graph of the IWM. This showcases the volatility that occurred this week, and as well the Qs, which of course track the Nasdaq. Here, there is this big downswing here, which basically has to do with the fact that at this time it was also announced that not only Netflix here on Tuesday, but also Tesla on Wednesday had failed to reach the earnings expectations. However, later in the week, also as you could see in the IWM graph, this huge gap here was because of the fact that the CPI reading for September came in with an ideal number, which is slightly below the expected. And because that means that it's inflation is, even though it's higher than 2%, but it is easing up, and that opens the door for the Fed next week to lower interest rates. And because also this development, this even reinforces even more the idea that it's all but certain that the Fed will lower interest rates next week. But as far as the trades go, this, even though we managed to collect quite reasonable profit this week, and let's see here how much it was. So this trade, we closed this trade this week on the 23rd, and also this one over here on the 20th, because these calls of IWM were assigned, but those were sold last week, and were the position was closed and reached maturity this week. As well as all of these, we have to keep in mind that this call for the XLF was opened on the 23rd, but so on Thursday, but will expire only next week, so we cannot account for these. But as you can see here, we managed to collect a little bit more than $2,120. Now, it's important to note that, and I must say that I did a few mistakes, slight mistakes, but still a lot more money could have been earned. And so, yeah, this was something that has to be improved on my side moving forward. But yeah, and especially keeping in mind the sequence of events that were taking place this week. But basically, and to explain what happened here. And starting by the beginning of the week, we sold these two puts on XLF because and we basically used a quite lower strike price because there was a high volatile implied volatility on the options. So we managed to get quite a good premium out of these puts, which is reflected here in the yeah, this one right here. So we managed to see that 32% is a very good return for these puts, considering that this ETF has quite low volatility, and given the fact that there was a lot of implied volatility because of the Netflix earnings coming up, the earnings of also Tesla coming in, and especially the CPI reading, because these are weekly options, so the option would only expire after the reading of CPI. There was a lot of implied volatility embedded in these puts, so there was a good premium to be caught, and so um, we sold these puts, and we did not do anything else on Monday because we had these calls already sold from the week before, and we were waiting them to either expire worthless or being assigned, and we ended up indeed being assigned, breaking even. We sold them at 248, and we also bought these at 248 as well, as you can see here. Now, carrying on from here, yeah, as you can see here, these calls were assigned. Next week, on the next day, on Tuesday, we rather went for the Qs, and the reason for that is because the premium was quite good, and also there was still a lot of implied volatility in it, especially because of the Netflix trade, of the Netflix earnings coming up at the end of the day, and also the Tesla, some expectation about the Tesla earnings. But this was unaccounted for only for the Netflix because they announced the earnings at the end of Tuesday, and these puts expired worthless here, as you can see. So we collected this entire premium, which was I would say quite good. Also on the next day, on Wednesday, we reverted back to our previous modus operandi, by selling 12 puts on IWM here, and because we still had some extra cash left over, we also sold one put on ARKK here, as you can see, but because this was a very negative market, and these puts ended up being assigned. If you recall, on Wednesday the market went down significantly upon seeing that Tesla and Netflix were, but especially Netflix the day before, at the end of the ring, at the end of the market session, it failed the earnings, so there was quite a lot of volatility, and especially a downward swing. But and so we managed still to only sell this put at the end of the session, after most of the downswing had already gone. All right, had already passed by us, and we were assigned these shares. We bought them at 245, and then the next day we had to sell them. And here was probably the biggest mistake that we made, because even though the market closed, and let's put back here the IWM graph. Yeah, here. Now at the end of Wednesday, here the market closed at around 243, something like that, and the market opened here already at around 244 and some change. And at this point I decided, all right, let's sell an option with a strike price of 246. All right, But at this point, I set the premium that I wanted to receive, the minimum premium that I wanted to receive, and the options ended up not being sold, not so the trade was not filled. And at this point in time, the market start to come down quite a lot in this downswing here. All right, and at this point, I felt that all right, probably given the fact that at this point, Tesla missed the earnings, Netflix missed the earnings, this is going to be another downward session. And so I decided, all right, let's let's cancel the trade for the calls at 246 because the premiums were getting quite low at this point in here. By the time this downswing were taking place, I felt that I missed my chance to sell at a good premium while it was still on the upswing. And so I canceled the trade and sold the calls at 245. So basically attempting to breaking even on the shares. The trade was filled up, but as you can see, this was not a negative session at all, and basically this was was accounted for the fact that there was a big expectation for the CPI on the next day. And this was a big mistake, I think, because first of all, given that CPI would be coming next day, and it's a very high volatility event, we should not have sold an option expiring on. We should not have sold the calls expiring on this day, on Thursday. And why is that? Because the CPI was going to be announced before the market open on Friday. So if we sell some calls expiring on Thursday, the options will die anyway at the end of the session, and they don't have the implied volatility that reflects the CPI reading, because by the time the CPI reading comes around, the option no longer exists. It's dead. So we should have sold calls expiring on Friday, because then they will have the volatility reflective the reflective of the CPI, of the impending CPI reading. And of course, not only that, but we sell if we manage to do that. If we at this time would sell a 2-day option, it would make sense to try to sell with a higher strike price, even if we compromise on the premium, because if the reading becomes good, we would be able probably to sell the shares at 246, 247, even 248 perhaps. As this transpired, we could have sold even at 249, so almost $5,000 potentially could have been made, but plus of course the premium that comes with it. But that was not the case, and this was I would say a mistake that it should not been given the fact that we are doing this for quite some time, it should not have taken place. And so my hope that as the day developed was that, all right, probably given the fact that we received a quite good premium here on the 245 call, if by the end of the day the price is still hovering around 245, we may be able to buy back these calls that we sold, either with a small profit or by breaking even, because if my memory serves me correct, we managed to get, I think it was around 50 cents per share on these calls, if I'm not mistaken. No, was the day before. Yeah, so it was bought and it was sold. Yeah, it was 52 cents a share. So we managed to collect 52 cents. So if we had, for example, the stock remaining at around $245.30, 25 cents, 20 cents, or even 40 cents, At this point, it would be already very close to parity, and by being at parity, we would be able to bought back the calls at around 40 cents, 30 cents, something like that. So we would have a small profit. And then what we would do is sell calls again at the higher strike price, but expiring on the next day. But at this point, by the time by the time the shares were or the options were supposed to be trading at almost parity, with very little time value left, the stock was already here at around 247. So we would have to pay around $2 each one for each share to buy back the calls. We would have to incur a large loss, and so at this point it made no sense to buy those back and having basically a loss, and it would be a quite big one, about probably $1,500 to $2,000, in order to sell calls at a higher strike price. Now, in hindsight, if we did that, we would still have come out ahead, but and then we would be very much dependent on the CPI coming good, because if the CPI for some reason comes too hot and inflation was, for example, had creeped up, the stock market should have, or it was very likely that it would have come down, and we would not have been able to capitalize on that. So our trade would have gone really, really wrong. At this, the way things turned out to be, it still came good, but it was underwhelming. It could have gone so much better. We would have made so much more money, but because of this mistake, we kept a relatively small profit in comparison to what we would have made if we made the things right. But next week is going to be a week in which we can capitalize, we can try to improve and not make this mistake again, because it's going to be a big week with the earnings, with the Fed decision on Wednesday on interest rates. So this is going to be a high volatility event, along with the earnings of the high profile stocks that we already spoke about. And also there's going to be a meeting between the US President Donald Trump and the Chinese President Xi Jinping about trade, and it's going to be next Thursday. And so this can be or may not be a high volatility event, but at least we are guaranteed to have some volatility embedded in the options premiums because of the Fed and the earnings. And these earnings will be mostly crammed in between Wednesday and Thursday. So Wednesday is shaping up to be a very, very important day. So we'll have to wait and see, especially because we need to account for the time at which the earnings will be released, either before the market opens or after the market opens, so that we can align our trades accordingly to that, to capitalize on this added volatility. And so, yeah, the way things turned out, we sold back these shares at the end of Thursday. So we sold them at 245 as well, so we broke even. We still managed to collect 1100 in premiums. All right. By the way, on the assignment at 248 that we had on Monday, this wheel managed to gather us to collect $535.30. All right. So not as much, but here it was a bit better. Now, also by the end of the day on Thursday, because of the way the market behaved, we had to buy back this covered call here, because it was going pretty much worthless at this point. We bought back at 1 cent, and then we rolled over the position into a new XLF call, in which we received 15 cents for it. So it is it is here. So we bought back the call at 1 cent. We sold back again at 15 cents for next week. And then yesterday on Friday we sold 12 calls, 12 puts on IWM again. My intention was again to do the usual thing. We expect this to expire to be almost worthless, and before the end of the session we sell some QQQ's puts. However, and interesting situation here, even though the IWM, as you can see, ended up, it was trading at around 250, 251, but ended up at around 249. So it did not reach new all-time highs. With the triple Qs, yes, this was the case. It reached a new all-time high at 617, and it was trading at around 618 plus when we sold those puts, and we sold those puts at around 617 strike. I recall that this had a probability of being in the money, so the puts would not be assigned 91%. However, the market gave us some added suspense at the end of the day, because this is the chart for the day. I'm going to zoom in, and in the dying moments of the session it starts to go out like this, and it ended up hovering at around 617. All right, and this was already a move that it was right before the end the session. But at this point I was really concerned that there would be probably the assignment on the QQQ shares, and I was really not interested in holding these shares, especially because it is trading at all-time highs. And if for some reason we are not able to sell the shares back by Monday or even Tuesday, we will be we will be holding the shares at the time in which those high-profile earnings are released. So the fact that these earnings are coming up, all-time highs have been achieved, I decided, all right, I'm not going to take the risk. I don't want to be exposed during entire trading sessions to the Qs. So I decided, let's take the risk off the table, and I decided to buy this back. We sold the put at the puts at 9 cents, as you can see here, and we bought those back at 6 cents, and we collect a meager profit of a little bit less than 10 euros, but still, to give some peace to get some peace of mind, I think it was probably the best decision. And next week probably we will be focusing again on IWM, because these all-time highs of the Qs will certainly be tested upon those upcoming earnings announcements. Yeah, this was the entire week in a nutshell. And next week, yeah, promises to be a big one, and certainly profits will be significant because of the volatility that is expected to be there for most of the week. So I expect, and I will be very disappointed if we get less than $2,000 per of profit for the entire week. But we'll have to wait and see what happens. One final note here, as you can see, the RKK put expire worthless. The price was already close to 90 by the time the puts expired. So the puts have absolutely no value at all. But yeah, for the time, this is it, and hopefully I will have to check the total earnings or the earnings count that we have until 100,000, but I am expecting that this time it will be upwards again. So this is all. Feel free to leave your comments in the comment section down below. I'm also available on LinkedIn in case you need to ask me any questions, and of course feel free to like the video and subscribe to the channel, and we'll reconvene either on next Monday in the evening or on Tuesday morning to open up the week 66 of this challenge, and I'll see you there.